We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Michael Oliver from Momentum Structural Analysis. Michael, thanks for joining me today. How are you?
Good to be here, Tom. Thank you.
Always a pleasure to speak with you, Michael. And you were recently mentioned by Eric Sprott in his latest Kitco interview for your $250 target on silver. So I wanted to start by talking to you about silver, kind of how you came to that target. Is it an inflation-adjusted previous high, a momentum high, or just a ratio based upon its relationship to gold?
It's just an outlandish statement that I made in the past. No, it's quite realistic though. When markets go berserk in the latter part of their bull phases, which is quite typical of many markets, they tend to have that acceleration phase. Silver and gold certainly did back in 1979, 80, then again in 2010, 11. They've been going up for years, and suddenly they went vertical quickly. And also at that time, silver tended to sharply outperform gold to the point where you didn't even think it was the same market. It was so vertical. Silver has, I sent you a chart, in fact, a spread relationship with gold that we show going back 50 years, where what we look at is, and this makes a good point, it shows the peak reading each year, peak monthly close of silver versus gold. So in other words, each year, what was the highest closing ratio of silver to gold? Okay. Now we do it a different way. We divide silver per ounce into an ounce of gold and get it as a percent. Right now we're about 1.13%. Okay. But as you see, going back 50 years, 1974, in fact, that it gets up to 2%, that red line, in 21 of the 50 years. So it's hardly what you'd call abnormal to see silver at 2% of gold. And in fact, during bull trends, for example, back in 1979 and 80, it went up to 6.5% and spent a couple years up there at 4%. Okay. And then in the 2011, 10 and 11 surge, it got over 2%, went up to over 3%. Okay. Now, just keep that in mind. So when you have big bull trends, it even gets higher than the 2%, which is normal again. Right. And again, right now we're 1.13, 1.14%. We've technically analyzed not just silver and gold and their net trends and their momentum, but we analyzed the spread. We do it on a daily basis, on a monthly basis, to see if we can define breakout points that say that this lull that you see in the spread here, where for the last handful of years it's been 1.5% or so. In the last couple of years, about 1.3%. To analyze when we think that could break out and surge again up to what? A normal of 2%. Okay. And that's a big deal because that's almost a doubling of the current valuation of silver to gold. And it's just getting back to a norm. So if you took gold to, $8,000, now why do I throw out that number? I do it all the time because simply if you go back and look over the last 50 years, there've been a couple bull markets. It have been 8-fold moves in gold from bear low to bull high. Well, we started from 1,050 back in 2015 at the bear low. Well, 8 folds over $8,000. And that would be simply saying, well, gold's going to do the same thing it did a couple times before. So we're not projecting 8,000. In fact, I've got some friends who are very thoughtful fundamentalists who think it can go in the 20,000s. Okay, forget that. But right now, we think that this spread is about to turn up. In fact, we've had a short-term indicator as of last week that said it is turning now. And we've got certain other levels not far above that tell us we're going to that 2% again. Well, that's a big move. And these spread moves don't occur with silver and gold going down. They occur when they're going up. Okay, silver simply outpaces. So right now, if somebody, asks me, what's the best thing to do this year? far as investments, I would be long silver, and I'd be long gold and silver miners relative to gold. Gold's the mama. It's going to lead the way up, but it's not going to lead in performance terms. These two subsets of the monetary metal sector will lead. I think it's the best place to be. And this chart merely reaffirms that, hey, it's no big deal to say we'd go to 2%.
Michael, what does that end up equating to in it, like price wise?
Let's say gold just sat here at 3,000 and gold and silver went to 2%, it'd be $60. Okay, so obviously gold's not going to sit here if silver goes up, but let's say gold went to 5,000. You do the math. Get 2% of the number. If gold had the normal eightfold move, and again in 1980 and in 2011, much of that came in the last year of the gold move. Okay, so if you do that, then $8,000. You do the math. What is it? It's $160, something like that, okay. So the main point is that silver could vastly beat gold, and it looks like the technicals are ripe for that. It's certainly not going down versus gold. It's sat in a range since late 2022, in fact, frankly, at better levels than it was then.
We can actually start with this one.
That's gold versus the stock market.
Yeah, gold versus the S&P, and that's kind of where I wanted to go next, because you recently wrote in the weekend report that, sorry, let me just find my note here, that asset managers are at least starting to notice the stock market's risk reward shifting to the darker. No doubt a few will likely soon, many of them will be moving more assets out of that bursting bubble and into gold. So I wanted to ask you, is this due to the safety of gold, or because of, let's say, gold and its outperformance versus the stock market?
Various things. One, perception that the stock market is no longer a great risk reward asset. It's now a risk asset. Okay. And once they become aware of that by getting kicked in the shins and then in the gut, as we're seeing, even today as we're speaking, we're getting clobbered again in the stock market. What this shows is simply since 2020. Remember back in the summer of 2020, we had a big upside move in gold, silver, and the miners. And in that time, gold shot up versus the stock market relatively. It got up to a 60% level, meaning the price of an ounce of gold was 60% of the price of the S&P. Okay. And then it pulled back. And since 2021, early 2022, it got down under 40%, like 37.5%, and it shot up again and lived mainly around the 45% level, but in a range, technical clear range. Bumped the top of that range at about 47, 48%, about 4 times. It was like a ceiling. Well, last month marginally closed out above it, and this month, intra-month, you're well out above it, which is that last reading. So what it tells us is that technically, gold is shifting to an outperform mode versus the S&P. We thought that would occur simultaneous with the breakage in the stock market. So it's not merely a function of gold holding steady and moving up, but the stock market going down as well. Well, that, of course, catches the attention of asset managers because they can't be in a place that's bad if there's another place to be. And they've historically gone to T-bonds and gold. 2000 to 2002, 2007 to 2009, they moved into those assets. Right now, T-bonds are getting a rally, and I think it's largely because of the sense of danger in the stock market. But gold has been outperforming both widely, as you saw in that chart. It's not just the last few months, but last couple of years, it's well off that low. So that indicates there is a shift underlying, even though they're not beating the table about it, of money moving into gold and related.
I like this. This chart here too, of gold's weekly momentum here, because I think that also shows this strength that is, just building gold, right?
Well, yeah, we had a pause. This is a weeklies, and this is up through last week. Okay. You can see weekly price up there punching at 29.70, 29.60, 29.70. Okay, that ain't a top. Okay, you don't top that way, even on a short-term basis. Right now, gold is down a bit on the week from where it closed last week, which is back over 2,900. And we're having what's called a corrective process for price. It's a standstill pullback, and it's just a pause, and with flat highs. And notice the high back in back in November. You see that high at 2,800? You didn't stick around up there for 3-4 weeks. You made a high, you started down. Okay. This time we're hanging in there. In fact, I think it's just a launch pad. But meanwhile, momentum has had a corrective process. We've been down for like 1, 2, 3, 4 weeks here. Okay, so momentum has cooled off from what was an overbought level. Okay, and you've done it without hurting price. Okay, so we're already starting to turn back up. Last week turned up, and I think we're going to turn up more this week, especially as you get later in the week. But anyway, this just shows what gold's been doing weekly since back in early 2024. I think
Michael,
go ahead.
Mm-hmm. The other thing I wanted to go through with you was asking, what part of the stock market is, let's say, most fragile at this point. We see this outperformance, and we just went over that chart of gold to the S&P. But what about something like the Nasdaq? Nasdaq has had a lot of speculative money flow into it.
Yeah. It was the leader on the upside. It'll be the leader on the downside. This was the case back in the .com period where, the S&P dropped 50% between 2000 and 2002. Nasdaq 100 went down 82%. Okay, it had led on the upside and leader on the downside. The same is true this time. Since 2009, the Nasdaq 100 went up about 18-fold to its highs a couple of months ago. S&P went up about 8-9-fold. So you can double the performance of the S&P. The downside will be the same. However, don't take your eyes off of other sectors. I know everybody's focused just on, the big seven thing, and NVIDIA. Watch the banks, watch commercial real estate. When you create a stock market bubble of that duration and dimension, we've never had one like this in U.S. stock market history, of that many years up with that much dimension, caused, no doubt, by monetary policy. QEs ad infinitum, Fed funds rate at 0 for 10 of the 15 years, et cetera. No wonder you had a big bull. It creates errors, creates stock market errors, it creates investment errors, it creates corporate spending errors, family spending errors. And when it breaks, when they rip the bandage off and, take the needle out and you don't know no more hallucinogenic drugs, it goes to hell. And that will lead. But debt is a problem, not just government debt, but private. And it's particularly in the commercial real estate area I'd be watching. But even today, for example, stock market down 1% or 2%, but the banks are down, some of them down 5-6%. Okay, so you got to watch that sector as well. But generally, the leadership on the downside will be what had led the upside. That's the Nasdaq 100.
Mm-hmm. And as we see on this chart, momentum is kind of breaking a bit of a structure.
Last week, yeah. Mm-hmm. That on the price chart, and by the way, that red line on the price chart is a 3-quarter moving average. Mm-hmm. What we do is we average the prior three quarters of action and come up with an average, and that average applies for the next quarter. So it only shifts once a quarter. It's a chunking moving average. Okay, and if you plot the weekly closes on the chart in the bottom in their relationship to that average, you have a flat floor that's been hit 1, 2, 3, 4 times in the past year plus. Okay, you broke it last week, so we finally pulled that plug, and right now we're down below the zero line as well this week. So it's starting to really come apart. This is a long-term metric, and when it breaks, it means business. So as far as we're concerned, top is in place. The only issue now is not whether you're going to get a bear market, but the nature of the bear. Does it crash? Possible, unlikely, more likely we're going to find next support of any consequence where you get a bounce that people might notice, not just a day or two, but let's say, a handful of weeks, about 12% below where you are now. Now, a crash is historically 1987, the COVID crash, all 35% in a matter of a couple of weeks. Okay. Not 10, 12% slabs. So we could slab our way down seriously without crashing. And I think the next support is, like I said, while we're talking about 12% below where the market is right now. There's various reasons for that. But I don't necessarily foresee a crash event, but one definitely jolts asset managers further into some other place to be. And also, there's the average Joe out there who's looks around at the horizon of his life and says, gee, there's only one thing I've been smiling about for the last, handful of months. My stock market portfolio, my retirement account. Last year went up 20%. Oh boy. Now suddenly, you're going to lose 20%. You drop another 12, you'll be 20% off the high. And he'll say, uh-oh. That's when emotion comes into play. Political emotion, hands in the air type emotion, which has not been in play yet. And I think it could easily come into play and be a factor.
Mm-hmm. Well, you and I have spoken before about this, let's say the nature of this next big move in the stock market being a lot more grinding than, shock and awe, just a big drop. Do you still feel that way?
Yeah, I still think he could be in dramatic slabs, but I don't necessarily see the 35% deal in 2 weeks. Mm-hmm. Those don't. Usually, a bear market doesn't start that way. In fact, 2000 to 2002, there was no crash, a bloody decline, but it did with no 35% in a matter of weeks. You go back to 2007 to 9, a year after the bull market peak, and about 6 months before the final low, there was a crash type event. You went down like in October of 2008, a full year off the high. You finally had what was like a crash event. Mm-hmm. But it's not necessarily a starting point. It only might become obvious later, when everybody finally gives up and, et cetera. Right now, I think the shock effect is beginning to hit. And I suspect what will happen next, sort of a fundamental off to the right here, is going to be the Fed finally does start cutting rates. I know they don't want to because it would help Trump. Okay, there's an antagonism there. But when they start to get data points that validate the need to cut rates, and they're going to get them, because when the stock market breaks, usually shortly after that, you start to see the data points. They don't come before, they come after. Mm-hmm. And, manufacturing slows down, all kinds of numbers turn south quickly. And that's when the Fed will have to start cutting. Problem is, whenever they do that, it doesn't work. It didn't work in 2000, 2002, 2007 to 9. They cut rates like crazy and it didn't stop anything. The money went elsewhere, went into gold, went into T-bonds.
So, Michael, what does all of this end up meaning for the miners as well?
But for the miners, mm-hmm. Well, look at this chart. This is XAU index of gold and silver miners. They have quite a few silver miners in it, so don't make that mistake. What it shows is every month's close of XAU expressed as a percent of the price of gold. You divide XAU into gold, express it as a percent. This starts in 1984, this chart, because XAU goes way back then. From 1984 to 2008, it lived above that red horizontal line, meaning its valuation to the gold was 17.5% was low, and the upside reached well over 30 multiple times, 30%. In the 2010, 11, 12, 13, 14, 15 drop in that spread, and it bottomed coincident with the bear market low in gold and the miners back in late 2015, this spread did. It dropped to 4%. You talk about a collapse in valuation. That's a collapse. Since then, it's lived at a higher level. I mean, it's actually beat gold. Doesn't look like it here, but it's higher than it was then. So it's actually gone up more in price. But it's still dirt cheap compared to an ounce of gold. It's been denied by investors is the main reason, I think. They simply don't acknowledge it. And investors are quite often wrong at highs. They get excessive, and they're often wrong at lows where they don't see any hope, okay? Well, this market actually, the gold miners, has held quite steady versus gold. And if you ran this same thing versus the S&P, you'd see the same type of picture. Very cheap, but not going down. Actually higher than it was in late 2015. The question is, when will it turn up? Because when you turn up, look at that red line above you, the big horizontal. It's at 17.5%. Right now, we're above 5%. That's a tripling. Just to break out of the bottoming range, break out over the downtrend line, and rush up to that next resistance, when you break out of the base, that's likely where you're going. That would imply a tripling in the value of the miners from current valuation levels to that resistance. And getting there is no big deal because that's the bottom side of prior decades. So we see this chart as being a basing. If this were a price chart, you'd be looking at it saying, well, that looks like a base. And certainly if you break the gray line, then you break the top of the basing range, you'd start paying attention. That's what we're focused on. And we're already seeing evidence of that when we focus in a little closer on these spread relationships, where we see the miners starting to emerge.
Michael, is that just from a quantitative aspect is where you're seeing this ratio start to shift? Is it only from the numbers, or is there something fundamental that you're also kind of seeing along with it?
Well, we don't try to or want to fundamentally analyze the miners because we're technical. We don't want to be biased by so-called fundamentals. Often fundamentals can be true and real, but they don't take place until the market wants to make it take place. And it's obvious that, gold miners are doing pretty good. Their cost of production is way below the current price of gold. And yet everybody's ignored them. They're doing better than most of the stock market, actually, company by company, a lot of them. And once we think the causal factor to make this spread go up is not that suddenly gold's going to go up more and therefore the miners are even making more per ounce they get out of the ground, but because money flows out of the broken bubble and goes somewhere else. And any asset manager who calls his technician from the back room and says, "Hey, Joe, tell me what's doing best," the guy would show him the spread charts and say, gold's beating the S&P for the last couple of years, boss. It's breaking out of this range. And even though you don't like gold, it's beating it, okay? Not just the last few months. I'm talking a couple of years. Plus, it's breaking out of the range that we saw earlier. And the miners are about to do the same. And they've actually been beating the S&P anyway. Marginally, but yes, beating it. Nobody's pounding the table about that. I'm talking about going back to 2015 to the present. So over the last 10 years, if you bought XAU in December of 2015 or bought gold miners, a basket, you're doing better than the stock market, believe it or not. Okay. The question is, when will they come out of that depressed hole? And I think the bubble breaking in the stock market is the causal factor. They'll simply cause the money to flow. So it's sort of a technical issue. Stock market breaks, it goes somewhere. It always does.
So it's not necessarily that it's just this capital rotation event.
Yeah, but it's a valuation too, as you saw. But it's just, when does it get recognized by investors, portfolio managers? And that occurs when they finally are looking for something else to do. And they finally wake up and say, I got to get out of this beast and get into something else. And that's when they smack themselves for having not acknowledged it already.
Well, Michael, if we don't get a dramatic sell-off, a very dramatic, like I said, shock and awe type drop in the stock market, that points towards the possibility that this grinding lower and then recognition that the stock markets are grinding lower, that contrast and that situation makes me think that we won't necessarily see as dramatic of a sell-off in gold as many point to. If we get a crash in the stock markets, we'll get a subsequent crash in the precious metals and miners along with it.
No, we debate that argument. We think that notion, while it prevails among many people and asset managers, is false. There are only a few examples in history where when you start a bear market in stocks, the gold didn't go up. Yes, in October of 2008, in the middle of a bull trend, gold started from lows in 2001 and 2 up to 2011. So for a decade, it went up. Yeah, in the middle of that move, it did have a very sharp bad month in October 2008 when the stock market did have a crash point in an already existing bear market in the stocks. So while stocks have been going down from 2007 to 8, gold went up. It was only when that crash event occurred in October of 2008, full year off the bear high and bull high in the stock market, that gold finally had one too. But it lasted like 1 month, and within 3 or 4 months, it was back to the high, while stock market was continuing down. So those type of events are exceptional. They're rare, and don't let them confuse you about the divergence in their trends. And this time around, I think the T-bond alternative, which is being sought right now, you can tell by the action of the last several months. We've called this and said there should be a T-bond rally, and there is one now. And I think it's got more to go. But it isn't a long-term thing. Gold is in a long-term trend. T-bonds are having what we call a counter-trend rally. So it's not as good of an alternative this time as it was between 2000 onward and 2007 onward. T-bonds were a better alternative to the stock market and equal to gold. Not anymore. This time they won't be. Gold will be the isolated event. And I think that's largely due to things we all know. One, we've got stock market bubble we've never seen, so damage is going to be huge and will cause central banks to go absolutely nutcase in terms of whatever ammunition they can throw at it, they're going to throw it. But as history shows, it goes elsewhere. And that elsewhere is almost always gold and related. So I view the stock market decline now, even if you have some sharp points like a 15% here or there, as non-threats, but a fuel for gold.
Well, as we're talking about fuel for gold as well, I want to get your take on the dollar. Like, I think this is another important point and another, especially considering that gold is priced as contrast to the dollar. If the dollar starts to break down or get stronger, that obviously affects gold as well. So considering, and we can kind of tie in Trump's need for a weaker dollar as well into this.
Not that he's going to shape reality, because certain things are not going to go his way. Like, during since Obama time, the stock market went up during Biden. Now suddenly Trump's in there and it's going down. So I'm sure he doesn't particularly like that. Has to acknowledge it, but it has nothing to do with him directly. It's events that are much bigger than who's in office this 4-year period. The dollar was at 160 plus. This starts in 2004, this chart. But prior to that, it was up in the 160s back in the 1980s. Okay, so it collapsed down to near 70 in 2008. And by the way, those who think the dollar goes opposite the stock market, it doesn't, okay? And when did it bottom? It bottomed in early to mid 2008. Stock market bottomed in early 2009, and they both trended up since. What did the dollar do since? Trended up, okay? So they've been in broad sync, okay? Now, but the problem is, and no, we didn't get back anywhere near the old highs in the dollar index. And by the way, the dollar index is merely an inversion of the euro and the yen, basically. They constitute about 70% of the index. So it's this paper versus 2 other pieces of paper, okay? But when we plot annual momentum, what we do here is you can see on the top chart, we've overlaid the 3-year moving average. On the bottom chart, we oscillate the monthly price bars and their relationship to above or below the 0 line, which is the 3-year average. And as you can see, last year there was a drop that came down and hit that 0 line and bounced to the red arrow on the momentum chart. That was late last year, made a high up there at 110. And the momentum shot up to a lower high, but price took out the range highs in the top chart there. You can see there's a gray range. We popped through that, breaking out, exciting all the dollar bulls, and then quickly aborted. Oops, it didn't succeed. It's now trading around 104. The problem is that this momentum chart has a trend line that goes back to 2005. So it's a 20-year trend line. And you're nipping it right now. And we argue if you close a month out during this year below the 3-year average, which is 104.28, and as we speak, it's below there right now. You close a month out below that number, and this uptrend going back 20 years is broken. It's a momentum uptrend. If you try to draw the same line on price, you'd have to get down in the mid to lower 90s to break it. But momentum always leads. Mm-hmm. And in this case, it's going to break where you're standing if you close the month out where we're trading. And we argue that that will likely lead to a major decline in the dollar, quite probably one that could take you back down to the 80 or 70 level, which is the lows of the last decades. But, we need to see the close below 104.28. Right now, we're trading below it. We'll see how it closes. And that's any month this year. But this is a variable that hasn't had an impact, because look at the range on the price chart at the top, the little gray range. That's a 2-year wide range. It's been stuck, except for that few month exception where it popped through the top and then failed, in about a 7% range for 2 years plus. That's called dull. That's called non-event. We call it the quiet one. Okay. It's going to get loud here quickly. But that has not been a moving factor for other markets because it's not moved. But if all of a sudden major foreign exchange gets volatile, that's another dynamic that will impact other asset categories and create what? More volatility. And we argue in the case of the stock market, probably more downside. And we think it'll help boost commodities. Commodities, in our view, are transitioning back to the upside. And of course, will help gold. Though it's not a primary for gold, it'll help.
Well, it's interesting to think about that as well from, how that ends up suiting Trump's aims again of increasing exports and a weaker dollar helping the rest of the world as well.
Yeah, it may help, and now this isn't necessarily caused by him. Mm-hmm. Again, these factors are way too big for any given president. Okay, mm-hmm. It's what happens over decades of decaying money, decaying value of the money units on a competitive basis. Who decays faster? And it's hard to judge that because they're in rapid decay in terms of the quantity of money increased every year in Japan, Europe, here, et cetera. So it's going to be a factor, and I think it's going to come into play. And it happens to be what? We're breaking that line I showed on momentum of the dollar at the same time we were breaking some lines on the NASDAQ 100. Isn't that interesting? Okay. Downside dynamics being engaged. So this is another factor that's going to create more noise and more movement in other assets.
Well, exactly. As we're talking about those other assets, I wanted to move to oil. Like seeing this is something I actually spoke to John Williams in the last couple of weeks about too, and I really wanted to try to wrap my head around the reality of the economic situation and the reality of what Trump is actually taking over versus the market optimism of his actual win. What is the oil chart telling us?
Well, go ahead.
What is the oil chart telling us that about its strength and the typical performance or the typical way that the oil market behaves when an economy slows down?
Okay. We think that oil is first off, back in that surge that you see from 2020 lows up to the 2022 highs, oil went from like $10 to 130. Okay. Big move. It outperformed at the same time, by the way, the Bloomberg Commodity Index was soaring. In fact, back in October of 2020, a couple months off this crude low, in fact, we called for a major upside explosion, we said, in commodities. Well, they doubled. Now, oil did more than double because it got knocked off the page there in early 2020, ridiculously off the page. So it outperformed. We argue this time, while the Bloomberg is starting to turn up, you don't see it on oil here. Instead, you see the last few monthly bars are dropping. And of course, you can say, well, Trump said drill, drill, drill. Okay, fine, that makes sense. But that's not an instantaneous command, okay? It doesn't happen like that, you know. And look at the momentum, quarterly momentum of the crude oil market here. That's the chart at the bottom. We oscillate the monthly ranges in relation to a 3-quarter moving average. And we've plotted a trend line through 1, 2, 3, 4, 5 peak monthly closing readings on the oscillator. Beautiful trend line. And you failed at it again recently. That's called an old trend structure. It's very old. It's very clear. And usually when momentum builds something like that, it's for use as a breakout level. So we're getting a pullback now, and it wouldn't shock me. Doesn't have to happen. But look at the price chart again. You'll see that the lows over the last couple of years have all been below 65, let's say. Right now, we're trading today down around 66. Okay. Wouldn't shock me that we go nip out those lows to suck in more bears. Because they'll say, oh, see, you just blew all the lows of multiple years. Momentum won't be breaking those lows. It won't be confirming that. But if you do that, and next thing you know, oil jerks back up, next quarter, meaning for 3 weeks, the zero line on that momentum chart, in other words, a breakout level, will drop to 71.5 area. Okay? Not all that far above you. You know, it won't necessarily excite the price guys, but for momentum, it says, I'm out of here. Okay. We think the commodity complex is turning up. In fact, if you look at the grains, you'll see it. You look at a lot of the components of Bloomberg, they are turning up. Oil is the exception this time. And I don't think it'll stay the exception, meaning I think this downside we're seeing in oil could very well be a bear trap. Where, yeah, you go a little lower. It looks like Trump's getting his way. They're going to drill, 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 and all that's good. Fine. I'm all for it. But this thing's looking at bigger issues. And it says, I'm ripe to turn up. Now, it could be a function of other things. Collapsing dollar, for example. Maybe certain events elsewhere in the world, that jeopardize oil supply for 6 months or a year, or whatever, something in the Mideast. I don't know. But technically, this thing says, yeah, it's still in a downtrend, but it's ripe for an upturn.
Yeah, it seems like it's signaling there's a reversal very likely coming.
Potential, yeah. Mm-hmm.
And again, the price and the momentum charts can kind of precede the story that ends up seeming like the catalyst.
Yeah, usually it's after the fact. You see, why'd that occur? And then 6 months later, you suddenly realize, oh gosh, why didn't I get long? But that's the way it is.
So, Michael, what's your impression of the new administration's pace and handling, let's say, of the first 50 days of this second term?
Well, I don't let my politics get into my analysis, but I do have a view, as you know. I wrote a book 53 years ago defining the concept of anarcho-capitalism, and lo and behold, we now have a president in Argentina who declares himself to be anarcho-capitalist. So dismantling of government is not something I'm against, okay? But remember, what goes on, it's a response to something that somehow a lot of people simply don't like. They don't like what's been going on for decades. They don't like the consequences of it. They don't like some of the institutions. And they may not know exactly what they want to see. Instead, they just know, shatter it, get it out of here, okay? And so sometimes you see a guy like Javier Milei take an axe to the government.
Chainsaw.
So far the population's applauding it because he's collapsed rental prices to levels people can now afford because he abolished the government control over rentals, okay? but examples like that. But they're popping up here and there on different issues around the world. So it's not isolated to there or to Trump. Trump is merely part of probably a global phenomenon where elements around the world are saying, I don't like this. This hasn't been working for decades. Let's get rid of this. And
seems like a cyclical swing back to the right.
Yeah, in other words, a different reality emerging, and without super clarity of definition as to what it's going to be, but we know we need something lesser, something different. Okay. And so it's going to happen. And when you do that at the same time, you have a bursting asset bubble created by government spending over decades, not just during Biden or anything like that. I don't blame it on him. It goes back many decades, this process, nearly 100 years at least, where it's created an asset bubble like we've got in the stock market. When it breaks, it's out of control. And it's going to have consequences that will add to the emotion. And some people will say, I see what Trump did. But it has nothing to do with him. It has to do with an unwinding of a certain reality. So what do I think about it? That's broadly what I think. He's sort of a piece of history, not a causal factor, but he happened to be there at the right time. Okay. He's already mentioned some things I think will happen. And a couple of years ago, during interviews, I said these will likely happen if he emerged again. One is you'd abolish the Fed. Okay, there's already a couple senators or congressmen on the Republican side, a few of them, who've put forward bills to abolish the Fed. Okay, that I bet that happens. Now it'll take an economic crisis where people, even friends of the Fed, will say, you guys waited too long. You choked things off too long, and now look what you've done. Okay, so even they're not going to be on the Fed side. And they've already spoken out. And then there's others who intellectually, academically, have attacked the Fed on a conceptual basis. Mises Institute, for example, is one of the major think tanks in the country. They're of libertarian bent. They had a full-page essay in the Wall Street Journal about 4 months ago. It said, end the Fed. Okay, and I think it's going to get traction, but what's going to cause that traction is a sense of panic. What causes the sense of panic? You push a bubble, you punch a big hole in that stock market. That will create the panic.
Some pain is needed for that.
Pain, yeah. And another thing, Trump is now getting, if the stock market breaks, as we argue it is, and the average Joe out there, even the people who might not have normally voted for him, but who did, working class folks, who said, I want change, okay? Suddenly they see the stock market break and they make the intellectual mistake of, he's president and it broke. He's got one thing he can throw out there to make everybody smile. Abolish income taxes. He's already said he might do it. He kind of wants to do it. There are many Republicans who want to. They need an excuse. And what would be the excuse? The dysfunctionality of the IRS, and already they're cutting its payroll and its employees sharply. I don't know how they can even audit people anymore, if you know what I mean, because their employee base is cut and they need more. They don't bring in the amount of money they were expected to bring in, so they're not functional as a government source of revenue. Tariffs, Trump has argued, we had that before we had taxes, income taxes, which have only been around 100 years or whatever. He said we can go back that way again. He needs an excuse, and if he had frowns on the faces of the broad American public, fear, he could give them this great moment of joy. Said, hey, no taxes. We're going to tariffs, or we're going to a national sales tax as well. It wouldn't shock me that happens. And all he needs is a good excuse to do it, because it would be an exceptionally popular thing to do. Anyway, these are the type of wild card events that aren't really wild cards. They're out there. And don't be surprised that when all these things start to move more violently, dollar breaks down, stock market breaks down, people get upset, emotions come into play, good and bad emotions. That things like this will happen. So we'll see. I'm not advocating. I'm just an analyst from above, okay? So anyway, that's what I see as potentials that are real world side effects of the technicals we've been talking about.
So, Michael, considering that you have this very dispassionate way about analyzing these markets, do you see there being a possible catalyst for Trump being able to enact some of these changes based upon these pain points that might be presented by the markets as this external stimulus? If we do get a big drop, if we do start, most people start to see that inflation is really cutting into their ability to do anything. This, to me, seems like a possible catalyst time for Trump to be able to make some of these big changes with the support.
We argue that one, as I said before, Bloomberg commodity index is turning up, we think. And there's certain levels we want to see just above it where it's trading right now, see monthly closes to affirm that view. But if we see that, that's going to also go opposite to what Trump has said, I'm going to lower your consumer prices. Ultimately, yeah, he might. But in the process, the commodity index is also going to be where assets flow, which will hurt him. Okay. Mm-hmm. Oh, God, prices going back up. What if oil turns around from some kind of bear low here and flips back up and breaks out on that chart I showed you? Oh, then they feel it at the gas pump. He needs something to make people smile, to counteract that. And the only thing he can do that would hit directly and immediately is to cut taxes. Now, even if he mentioned it again, I'm just suspecting, even if he mentioned it as something he'd like to see done and needs Congress maybe to do it, in a dark economic environment where you start to see recessionary numbers, you start to see the stock market another 10% below where it is now, people start to frown, they've wasted all of last year's gains in the stock market, get erased, that kind of thing. He can throw this out, make people feel good. And especially if there's public pain out there due to all these factors, even some Democrats are going to feel like, my voting public in my district says, yeah, they want taxes abolished. And so you might even get some Democrat votes to enable this to happen. But even if he mentioned it, think about this. The people out there who are pinched because of these events, and they made good money last year and they owe it this year, and all of a sudden their reality is changing. I wonder how many of them would request a delay, 90-day, or payment plan, or simply not pay in hopes that this reality is in fact going to occur, meaning help cascade the reality into actuality without any political events occurring. Merely the public says, we're not paying because you're going to tell us we're not going to pay anyway. Why pay now? Okay, I don't know. I'm not advocating. I'm just saying, as these events start to cascade and erupt, political outcomes might be quicker than you think, where this notion of abolishing taxes might not be so hard to do. And, the question is it going to happen this year or next year? I don't know. But these events could happen quickly, cause pain, cause events that you didn't expect to happen, or events that might have happened but happened sooner. I don't know. These are things you should keep in mind because I think they're all variables that could come into play.
Well, I think, as you say, keeping in mind the idea that this is going to be a time of distinct change, whether or not Trump is the president, whether or not he's the actual person that is enacting it. I think that is something that we need to keep an objective eye on. And like you say, there are so many of these systems that have just run on cruise control that inevitably have to come to a head. And there is a big mess. Even if you want to look at it from the other perspective, or the generous perspective, that Trump has to clean up from the previous administrations, he might be saddled with that pain point.
Yeah, I think these events are beyond him. I know everybody likes to blame the current president, and that's a falsehood. Yeah, some things they do might be a added on factor to an ongoing trend. But Trump is basically throwing stones into the gear mechanisms, and somewhat at random, and you can't quite predict the guy. And I think one of the reasons is he might not care. he thinks he's part of history. I don't think he did in his first term, but I think in his second term, he realizes he's part of something bigger than him even. Mm-hmm. And that he just happens to be there. And what the heck? I'm going to make history. I'm not going to be just like any other. So if I break things, fine. Maybe they need to be broken. He has a different emotional view and a sloppier view, you might say, than other presidents. Mm-hmm. And maybe that's what history wanted. I don't know. But
he's willing to break a couple eggs in the process.
Yeah, and the outside factors fit with the timing of this. They were going to happen anyway. That stock market bubble was going to break. I don't care if she won. It's going to break. And she would have inherited it. But the point is, when these things happen, they're huge. This is a huge bubble, bigger than any we've ever seen. When it breaks, remember this 2007 to 9 hurt people. And yet it was only a 50% drop in the S&P, and it was mortgage related. And, it wasn't as big. We'd gone up from a low in 2002 to 2007. So 5-year bull market. This is a 15-year bull. 9-fold move in the S&P, 18 for NASDAQ. This is monstrous. When this guy comes down, all kinds of things will come down, and different realities like we're talking about will be impacted. And you just have to sort of be open and ready for that. And on the right side of which markets are going to do best and which are going to do worse. And we think we know which ones will.
Mm-hmm. Michael, going back to that point that you brought up about the book that you wrote about anarcho-capitalism, do you think DOGE is a step in the right direction?
Oh, yeah, it could be. I view it beyond any particular political event. Even Javier Milei and some things he's done I don't agree with. It doesn't matter. The point is that
at least we're getting
I merged Ayn Rand's basic philosophy with the economics and politics of Dr. Murray Rothbard, who founded the modern libertarian movement. In the 1970s. I knew him back in the early 70s. And I actually, perchance, bumped into Rand on the street corner in New York one time, too. Cool. My wife and I did. By chance, we lived a few blocks from her and accidentally bumped into her, said hello, and that's about it. But was a close friend of Rothbard's. But I combined their two philosophies. She was a limited government person, founding fathers concepts. Basically, she just dittoed that. But her philosophy was revolutionary, and I used it as the base and attached Rothbard's anarcho-capitalist economics on top of it and applied the name. And he used the same term at the same time. And there's been a debate among libertarians as to who came up with it first, him or me. And it was actually him. Yeah, I think he wrote an essay a few months before I did my thesis, which is now a book. But he applauded the book and anyway, but I'm not involved anymore. It's something I wrote when I was in my 20s, in fact. And it happens that part 3 of Atlas Shrugged, that people who've read that book know that, the things that were going wrong in parts 1 and 2 finally cascaded in part 3, where, statism collapsed, its errors collapsed, and people sought something else. Okay? And it didn't happen incrementally. There's finally a point where things changed, and it wasn't so much due to one person. John Galt didn't do it. He okay, you get the point. And it's not just going to be Trump. Trump just happens to be there in this wave of global situation, and I think it's unfolding. And people will seek out other alternatives, and I think those alternatives will generally be less and less statism, more and more markets. And we shall see. Again, I'm not active in the movement whatsoever. I'm focused on markets, have been for 50 plus years.
Yeah. Perfect. Well, for, just as an aside, I think that everybody needs to read Atlas Shrugged. It is just an excellent, excellent book. We've mentioned it on the podcast here before, and to hear you mention it as well is quite interesting, Michael. But always appreciate your time, sir. Is there anything that you'd like to leave our listeners to maybe think about before we wrap up?
No, just take care of yourself. Be ready for the expected but unexpected to most. Mm-hmm. Be ready for it, and if you anticipate it well, you'll actually benefit from it. A lot of people are going to get hurt by these events because when the bubble breaks and they're holding the bubble, it kind of hurts, But take care of yourself, and one way to do that is to be on the right side of certain major markets. where you have your assets, so that your assets don't go down with the bubble.
Mm-hmm. And of course, for anybody that wants to read more of the charts and the work that we showed on screen here today and that we went over, that's all available at olivermsa.com. And of course, on Twitter as well, at Oliver_MSA. Michael, thanks so much for your time today.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.